So, has anyone heard of CFED before?
No. No.
This CFED, Centre for Financial Education? No? Okay. That's not a surprise because we haven't worked with the Thalidomide Trust before, so good feedback please, because I think we're on trial today. Yes, we began life as Keystone Financial Education, and we were part of a financial advisory firm, so everyone who works in the business is qualified as advisors, but at one point we were giving feedback to a not-for-profit organisation, and one of the senior members said, look, we've got a governor who said, or someone who sits on the board of governors, how do we know these guys are not going to flog products to our people just like every other IFA does who comes along? I said, well, that's a good point, but you've paid us not to do that, so we're not going to do that. And the lady said, well, that's good, Chris, and I know you and trust you with that, but this guy on the board's ex-finance, and he's had a look on the FSA website as it was then, and you guys are all authorised to give advice and sell products and what have you. I said, yeah. I said, are you sacking us? She went, no, but have a think about it. And that was the beginning of CFED 6 years ago now. So a couple of my colleagues who work within the business specialising in the training front, who preferred that, came away and set up CFED, Centre for Financial Education. And as I was going to mention in the meeting out there, the biggest difference between financial advice and financial education, well, what would you think biggest difference is? I've kind of given you a clue to start with.
Non-biased.
Yeah, exactly. We don't stand to gain. It's not financial advice and it's not financial product selling. So CFED hasn't taken up permissions to sell financial products. So if you come to me and you say, hey Chris, don't tell any of these people around here, but I won 100 grand on the scratch card last night, can you invest it for me? The answer's no, can't invest it for you. I can talk to you about how you might want to do it. And so the idea is, rather than selling products and advice, we give you, through education, the skills and tools to make your own financial choices. You may well, and in most cases, certainly with pensions, still want to ultimately seek advice from your advisor, but at least you'll know what you're speaking to them about before you get there. So that's the key. Main difference, we don't have an axe to grind. So whilst we're here, we work with a lot of good organisations really, because the employer pays for our time, not the employee. So it doesn't matter what we talk to you about, so our focus is always you. Football, anything like that. So our focus is always you. And that's probably why we end up working with good employers, because bad employers won't be paying us for our time, would I? And on that, these initial sessions are funded by the Trust. The reason I say the initial sessions, because we haven't decided where we're going yet. I guess it will depend on how the feedback is as to whether we're taking on retainer or what have you. We tend to work with not-for-profit organisations throughout the UK, mainly in housing. We do a lot of housing and people who want to look after their employees and educate them. And we do seminars like this. We also do follow-up sessions, and for many of them we're available round the clock as well if they've just got a query or a question. And it's not just, as you'll see at the end, it's not just pensions and retirement planning. You can talk about mortgages. What does my credit file mean? How do I improve my credit score? Anything like that to do with personal finance. So what about today's session then? What we're covering in today's session, it's not really Weight Watchers versus Slimming World, as I said. Today's session says on the door retirement planning, but you can't really cover retirement planning without talking about pensions first, can you? Because most people's retirement planning or retirement will be funded by the pension, won't it? So that's what we're going to look at first. Great. Is everyone cool with the format then? Everyone happy with where we're going? Okay, well, pensions and retirement planning, as I said, has got to kick off with pensions. Millions of different kinds of pensions, aren't there? One of the things that we realised, my colleague and I were delivering to an organisation one day and who had a particular pension, and everyone loved the session, went back, and we were doing one-to-ones a week after, and one of the delegates come back and said, listen, I've been home and talked to my husband, what you said about pension, and he said a load of rubbish, you're wrong. It's totally wrong, which of course I'll say at this point, it wasn't wrong, just he had a different type of pension, didn't he? So we're now, at that point, become aware that as well as covering people's pensioner who sat around the table or from that firm, we ought to cover the other types. So we set to and had a look at how many different types of pension there are. And what I mean by different types of pension are like, some people say I've got a personal pension, other people say I've got a SIP, or I've got a local authority pension. Dad used to call his superann, whatever that means there. So there's what I call different ones. How many different types of scheme do you think there are?
Loads.
Right. Well, at last count, we got to 29 after auto-enrolment had come in. 29 different sorts of pension. So the good news is today we're going to drill down into each and... No, we're not, of course we don't. So you're all getting up ready to go out then? No, because the good news is, even though there are 29 different ones and some of those that I shouted out, we figured out that whichever one you've got, they all fall into just one of two categories. That's pretty cool, isn't it? So what we are going to do is we're going to look at both of those. Because I don't expect to ask people around here, what have you got, what have you got? You don't want to discuss it in front of other beneficiaries really, do you? That's personal stuff. So I'm going on the assumption that some will have one, some will have the other, and some will probably have both types. Does anyone know what we call these two different types, how we generalise them?
Give it a shout. Is it defined benefit and defined contribution?
Excellent, excellent. That's is the right answer. There was just one person in the last session who got that as well. Yep, defined contribution, defined benefit. If you don't know it, don't worry, because they've been called all kinds of things before. Basically, a defined benefit, shouldn't term it as this really, but as I said at the beginning, this isn't advice, it's education. But defined benefit, many people would call final salary pensions, workplace pensions like that. Defined contribution, probably the more modern way. So if you didn't have a workplace pension, you started your own personal pension, that would be defined contribution. And most people who start a new job or in a new business now, businesses don't start defined benefit pensions really, they're on defined contributions. Often, something that's happening more and more often now, and we get involved with a lot, defined benefit schemes are closing to new accruals and switching to defined contribution. So some of you may have both. If you work in local government or civil service or the army or the police or the teachers, then your defined benefit, and as far as we can see, that's where that's going to stay as well. But otherwise, you could be either or. And like I say, I can't really ask people for coughing up to which one they're responsible for. So we're going to have a quick look at both. We're going to start with defined benefits, because that was the kind of original one, and if they close, they move to the new one. And the good news is with that, whilst when you get your statement, it looks really complicated, because it might say, oh right, yes, you have 14 years, 324 days in at that, at 60th, oh, hang on a minute, what? So whilst it looks really complicated on the statements, it actually follows a really simple formula. It's just a 3-part formula. If anyone wants to shout that out, I'll be super impressed then. It's the number of years that you're in the scheme divided by, and you know, when I said we like to speak in plain English or even plain Yorkshire, I lied, really. Or at this point I did, because it's a word you only ever hear in pensions, the accrual rate, which we'll come back and have a look at in a moment, I'll explain. So the number of years divided by the accrual rate times your final salary. That's why they're often called final salary schemes, or technically your final pensionable salary. So we've got two of these covered, haven't we? Everybody knows how long they've been in the scheme for. Everyone knows what the salary is when they finish in the scheme, but we might not know what the accrual rate is. And the accrual rate is really, it's the rate in which your pension grows every year, or accrues every year. So common ones, for example, are 60ths or 80ths. Anyone in LGPS or anyone familiar with LGPS? 60th and 80th accruals. And to explain how that works, if I had a cake and I divided it into, I told you it was Weight Watchers, didn't I? Divided it into 60 slices, or I had another cake that I divided into 80 slices, which cake has got the biggest slices? Good. Thought I were going to do all the work for a minute then. Yeah, it's 60. So I don't ask trick questions and don't try and catch people out, but just try and engage you a little bit more. What that means really is low is good. In accrual rates, the lower the number, the better. It means that every year you accrue a 60th, so you get a 60th of the cake towards your pension, and the cake is your final salary. So if you put in 60 years, if you're allowed to, you're not at the moment, but watch this space, eh? So you'd have 60 60ths, wouldn't you? What's another way of putting 60 60ths?
One.
Yeah, it's a whole one, isn't it? Exactly. So if your income when you left was £50,000 a year, and you got 60 60ths, your pension would be £50,000 a year. So it's really that simple. The problem is when we get our statements, of course, no one's done 60 60ths. You might have done 20 years and 49 days and half an hour or something like that. If you know your own numbers, you could work this out. So I'll do a basic one first. Say someone's been here 10 years in a 60th scheme, and they're working part-time on £10,000 a year. What would it be? Usually I dish the calculator out now, but I'm going to let you guys off because we're short of time. 10 divided by 60 times £10,000. Will you just verify for me that that says
1,666.
exactly that? So 1666, well, recurring effectively. So £1,666 a year pension that person's going to get. So now, and I can tell by the looks on some of the face, you're like, well, what's all the fuss about? But let's ramp it up a little bit. Let's say you stayed in 40 years in this same 60th scheme and you got a bit of promotion and you ended up on £60,000 a year. So where would that get us? 40 divided by 60 times £60,000 is just short of, Roland, thank you.
39,000, yeah, 40,000.
Yeah, 40 grand, virtually a penny short of 40 grand. So that will be a pension of £40,000 a year, and usually tied into some RPI, CPI, or what have you. See how that comes out? That's the one that we just did. 10 divided by 6 comes out 1666. But why I'm showing you this is because once you know the formula, you can put your own numbers in and check that it works out. There will be differences. Some will say, well, we've got a spouse's pension. Some will say there's a child's pension if you die and you leave a dependent child behind, etc. But that's the basis of it. So these were kind of carved in stone. Get to the end, £40,000. Where does the money come from? Effectively, I won't say you don't care, but it's not your responsibility. It's the responsibility of the scheme, and that's one of the most fundamental differences between a defined benefit and a defined contribution. So in this case, where the money comes from is the risk is taken by the scheme. Whereas in defined contribution, guess what then? Guess who the onus is on then? It's your own, isn't it? It's your own. Effectively, you're responsible for the risk. You're not, because it's managed by someone else. But if it goes up or it goes down, it goes up or it goes down. If the funds behind this go up or down, they've still got to give you what's been promised, really, which is why they have to put more contributions in when things are low. A defined contribution. Even easier to understand, really. How can it be easier than what you just explained there, Chris, I hear you say? But it is. It's really, once you've got your head round the control moving to you, it's really all about your pot. Now, when I'm working with employees, of course, I'll sometimes work with employees who we don't trust them, or them's usually the employer. It's nothing to do with the employer, really. The pot belongs to the employee, same as in auto-enrolment. They can move and take it with them. So it's literally, in fact, if you remove the word pension, which puts a lot of people off, and you call it, this is a savings pot with a set of rules, all we need to do is look at the rules. So I can't have a defined benefit scheme, but I can have a defined contribution scheme. So why would I? Why would I pay into one of these? I'm meant to know what I'm on about, aren't I? You know, Centre for Financial Education. Why do I put my money here? Well, if I'm looking at saving for my retirement, what are my options? Let's say I've got £100 spare every month. Where do most people put £100 to save it for the future? Yeah, savings account. Might be a bank, might be a building society, that would be the regular place. If I want to get £100 in a savings account, I've literally, see how old I am now, I've got to walk down to the bank with 100 quid in my hand or go online. But I've got to have £100. It costs me £100 to get £100 in, doesn't it? How much do you think it costs me to get £100 into a savings pot if I'm a basic rate taxpayer? There's the clue, right? It's actually, it's the flip, but I see where you're coming from there, Keith. It's £80. And the difference is what Keith said then, £20. How comes it cost me just £80 to get 100 in? Because hang on a minute, that's like having a 20% head start almost, isn't it, before it's even invested? Yeah, effectively. And it's described in lots of different ways, tax back, tax relief, whatever. And if there were a tax accountant here, he'd probably rip this to bits because technically there are issues, but we're looking at demonstrating the benefits of it, and effectively this is it. You put £80 in. Tax relief adds to it another 20 effectively, so you get 100 quid going in. So what about if you're a higher rate taxpayer? How much do you think it costs you then? Other way again? Yeah, you get 40% tax relief, so it only costs you £60. So every time you put £60 in, the government will top it up by £40 to make the 100.
They really do that?
Yes, there you go. It really is a little. I say when I'm talking to employees, if it's an hour's presentation, if you want to fall asleep for the presentation, fine, just stay awake for these 10 minutes because this is the important bit, innit? And if everyone got it, particularly young people, if everyone knew, if Barclays said we've got a sale this weekend, every £80 we're rounding up to 100, you wouldn't be able to get in, would you? Oh, and by the way, if you're a high rate taxpayer, we're putting another 40 on top of your 60. There'd be a queue a mile long, wouldn't there? That effectively is what your pension has. It just has a couple of rules which we'll look at shortly. But for many people who are employed, it's even better, isn't it? Who else might put some money in for them? Yeah, exactly. Wow. You stopped the right man in the lift this morning, didn't you?
I did.
So imagine if your employer comes along, and of course it can be different, but for example says, tell you what, don't you worry about that 80, we'll put half of it in for you, we'll put 40 in. So what do you have to find now? 40. You put 40 in, what does that get you in your pot? £100. That'd be a big queue at Barclays now, wouldn't it? And that is tax relief. I mean, it's a kind of shortcut, and we talked about your employer doesn't get 40% tax relief on their contributions, but you do on yours. But the fact is, the more you put in, the more tax relief. The more you put in, the more tax relief you'll get. Doesn't necessarily mean your employer will put in more. Your employer will have a structure of we put this in, you put that in. But that's the bit to let sink in really. And whilst I was joking really when I said you can fall asleep now, because it's quite important. As you can imagine, there's a flip side to this coin. Well, your money goes in the pot, and depending, I mean, a lot of people say, well, how much will I get back at the end? The only truthful answer is don't know, because it depends on a number of things, doesn't it? First of all, it depends on what you put in, what your employer puts in, what tax relief rates are, because they can change. And one thing about pension rules, they always change. And then, how's it invested? You know, that's when you choose who's looking after it, isn't it? Standard Life or Prudential or whatever. And this pot will grow, all being well. And when you decide you want to take your income, effectively you put a lid on it and you say, right, I'm off, I'll have it. So I know you'll all have varying states of what you've got kicking around, so I'm just using round figures for this. Being from Yorkshire, we've only just got calculators there, so let's, for easy adding up, assume that we've just got 100 grand in this pot to keep it nice and simple. Yeah. Do you reckon you can just take your 100 grand as tax-free cash? That'd be too good, wouldn't it? Too good to be true. Do you reckon you can take any of it as tax-free cash?
Yes.
Okay. 40,000? Okay, you're giving away how much you've got in your pot now, but
Oh yeah, that was
right, that's okay.
25%.
Yes, it is. It is. So it could well be 40,000, couldn't it? If you've got 860 in your pot. So there you go. 25% tax-free cash. Which in our example will be how much? Thank you. Which leaves how much? 75,000. So that's tax-free cash.
In a lump sum?
Yeah, lump sum.
Okay.
However you want. Don't have to take it, can take it. 25% of all your pensions put together, but you can take it, lump sum, tax-free cash, no tax to pay on it, wherever you do, wherever else you're earning, that's tax-free cash. You only take it once, of course. You can't let your pot grow again and have another 25%. But so that would leave £75,000, and this was the issue or the bugbear of many people up till recently, because the rules over that, somewhere in the wording, it really said had to go towards providing you with an income, which up until recently, for most people, certainly people who didn't have a financial advisor, would just be one product really. Does anyone know what that product's called? Again, it's like accrual rates, you only ever heard of it when you're talking pensions. It's called an annuity. Again, that's the only time you hear it. An annuity is effectively you giving up your lump for an income for life, which used to be fine. So annuities, probably much like endowments really, back in the day where they were originally dreamt up, proper products, were quite useful products. My dad, when he retired, when he was 60, can everyone remember when mortgage interest rates were 14 and 15%? It'd be right at the beginning of us. Keith should be shaking his head really. But,
Yeah, pretty much.
right.
Parents were hit by
Yes,
it
of course, yeah.
mid-80s.
Same for me, Keith. I'm in my 40s, I'm 40-14 me still. So when rates were like that, whilst annuity rates technically aren't linked to interest rates, there tends to be joined up trends there. So my dad got 12% on his money, so let's say he had 75 grand times 12% would give him 9,500 per annum. That's all right actually, for 75 grand, like, whoa, you'll have that, 12%. Anyone would take 12% of the money these days. Unfortunately, well, have a guess, what do you think a 60-year-old man would get these days? Not far off, yeah, add the two together. Nearer, and again, you can't just make figures up if it's advice, but it's not, it's education, but nearer 3%, which would give them 2,250
Per year.
per annum. And it's like, hang on a minute, yeah? So you can imagine people's faces, can't you, when they're being told to save, tax relief, great place to put your money, suddenly 250 a year, it's like, what? Hey? You're kidding me? You know, it's a con. You know, I used to get all kinds of reactions like that. Now, you could take more, but if you took more, that's the rate of tax you would pay. A punitive rate of 55%. So no one ever did they, of course? Unless you knew, you know, the end was nigh. So that put a lot of people off pension. It was one of the biggest gripes. And one of the reasons for the change in annuity rates, there are many reasons, world finances particular, but look at that. In 1948, a 65-year-old man would have a life expectancy of 12 years. By 2012, that had gone up to 21 years. For a woman, 15 years in 48 has moved up to 24 years. That's a significant growth, isn't it? I was looking for some up-to-date figures, but I think whilst we're capable of living longer because we're finding all these medical cures, nobody can get a bed in hospital now, so maybe it's coming the other way or levelling out. So that's had a significant effect, as well as kind of world finance things. But effectively, we get less in terms of annuities, so they're not as popular as they were. Still a good choice for people. Good news, all change. Unfortunately, the good news was swamped by a yellow Lamborghini. Then remember, in autumn 2014, a government minister standing outside Parliament saying, from April next year, one will be able to take one's pension however one likes. One could even buy a Lamborghini. Remember that? It was on the headlines all over. New changes to pension rules, which were great, but got swamped by pictures of yellow Lamborghinis all over the papers because that clown. Yeah, of course you can buy a yellow Lamborghini if you've got probably £1 million in your pension pot, but it it spoilt, really. I was massively disappointed because it spoilt what I thought was some excellent, you know, some good news about pensions at last. And this is what changed. So you still get tax relief on your money going in. One of the things I forgot to mention, as well as how you get it, is when. Does anyone know when you can access this money? Good, well done. You're reading the screen. Yeah, in the old days it was 55, and it still is at the moment, but by 2028 it's going up to 57. Shouldn't affect most of us guys. So yeah, nothing's really changed around there, and you can still get your 25% tax-free cash. But the big difference now is you can take the rest of the money, as the Minister said, pretty much how you like, subject to a couple of things. First of all, is your provider geared up to deal with it, because not all of them are. There will be, I'm sure. And secondly, and the biggest thing, income tax. So you can take your money however you like, subject to income tax. So let's have a look how that works. In fact, the best way to demonstrate how it works is to give you a real life example of mine. I'll just change the names and the numbers. Let's imagine the numbers are this. But I saw two guys, one called Ray and let's call the other one Malcolm. They'd worked in a housing association for a number of years and they were coming up to retirement. One were a chippy, a joiner, the other one were either a bricklayer or electrician, I think. And they were coming up to retirement, and Ray came in first and he'd seen the news and he went, right, I've heard I can have all my money as cash. And I went, right, okay, well you can. And before I could say what else, I went, right, I'll have it all as cash, as if I had it in my back pocket, you know. Sorry about that, cameraman. So I said, well you can, but you're going to have some tax to pay. He went, yep, that's fine, I'll take it all as cash. I went, you're going to have quite a bit of tax. Yeah, I know, I'll take it all as cash. But yeah, but if you draw £75,000 as income, it makes you a high rate taxpayer. You know, you're going to have 40% tax to pay. Yeah, I'll draw it all as cash. And he's kept going on. So I even worked it out for him, something like £19,000 in tax. Yes, give me it all as cash. So I went, right, okay, it's not my money, is it? I said, well, I'll show you how you go about doing that, but I should really ought to ask you why you've taken that, you know, route, really. He went, look, lad. It's nice when they call you lad, isn't it? Look, lad, I'm 62 now. Most of the men in my family are dead before they're 65. And it's like, oh, here's your cash. You know, he's thought about what he's done, hasn't he? He's thought about it. It's not just some mad decision and he's going to go and smoke himself to death in a room or something. He's thought about, you know, what his likelihood is. He wants to make sure he gets benefit from his money. So, you know, it's up to him what he does, isn't it? There are some alternatives, though. But as he left the room, he said, my mate Malcolm's in this afternoon. He'll be the same, you'll see. So Malcolm come in the afternoon and went, oh, my mate Ray says I can have all my money as cash. I went, oh, here we go again. Well, you can, but you're going to have to pay a bit of tax. What? Totally different reaction. Hit the roof. I knew this pension like were a con, he said. Tax relief on your money going in and, you know, all that, don't you worry. And now you want to take it back, as if it were me who were taxing him. Now you want to take it all back from me. I'm not paying any tax. I'll tell you what it is, your job today, you show me how I can get my money without paying any tax. So let's have a look at that. Is there a way in which Ray can get his 75 grand without paying any tax? Exactly, he can take increments, doesn't he? Because every year we're all entitled to what's called our personal allowance, aren't we? Anyone know what it is currently? Yeah, it's just gone up from 11.5 in April to 11,850. It's an awkward number, that, isn't it? Can't wait for next year. I think it's 12 grand. Make my job easy again. At the time of doing this, it was £11,000. So we just said, well, look, you can take 25 now, plus 11 this year, so that's 36, and 11 every year. And his goal was getting all his money tax-free, but he wanted to get it as quickly as he could. So it's going to last, it's going to all be gone in 7 years, isn't it? Or just over 7 years. And it's going to all be gone. But he was cool with that because then his other pensions kicked in later. So again, I must stress it's not advice that people do that. It's just an example to give you ideas, and he could do anything in between. But I think the idea of pension flexibility is great. Can you still get an annuity? Yes, of course you can, and for some people that will be the right way. If you think you're going to live to be, 101 and you want to make sure you've got a regular income till that point, annuities, great products. for you to look at from them. Now there are other changes. There's new taxation rules. They're kind of slightly more complex if anyone wants to look at them, and you can kind of get more involved in looking at how you would invest or how you'd go into what they call drawdown and try and control it so that you keep some money in the pot, but that will be more suitable for a one-to-one if any of you've got those going on. Because otherwise, remember, when that pot's gone, it's gone. Now, this is a little different for you guys, isn't it? Because as I understand it, you all have an annual income for life, really. So pension freedoms possibly have a bit more of an attraction to you guys who might want to say, look, I don't need so much the income because I've got that coming in. My pension money, I might want a bit more flexibly, want more of it when I'm younger and, you know, got the energy to spend it and things like that. So that's that. Word of warning. We've talked about two different types of pension scheme today. Do you remember? We've just done defined contribution. We started with defined benefit. If you're in defined benefit, before you get excited about the new pensions freedoms we've spoken about, the pension freedoms don't relate to defined benefit, they relate to defined contribution. Now I want to put a big warning flag up now and say that there are people out there, as there are in most areas, walks of life, who are out to try and, you know, grab some money for you and encourage you to move from a defined benefit scheme into a defined contribution so you can access your pot, which for some people may well be useful, but not for most. It's very dangerous stuff to do. It's really important, if you even consider that you do take advice, and the advice is really about what you're giving up. Because remember, the key fundamental difference is a defined benefit, the responsibility is with the scheme. With defined contribution, it's effectively with you. So definitely don't be kind of scammed into moving any money out of one with the other without taking some pretty in-depth advice down that road. Great. Okay. So retirement planning, of course, is not achievable to cover retirement planning in 45 minutes, let alone the last 15 minutes of a presentation. But that's good because often people try and do retirement planning in one session with an advisor who's quite possibly using type of language that we're unfamiliar with a lot of the time. So what I chose to do with this session is to get you thinking about and focusing on it. Again, sound like a broken record, but got to stress this. This isn't advice, it's just some ways for you to think about it. So, overall view, retirement planning. When we go to work, unless you're really looking, you're a footballer, gardener, or, you know, vet, or working as or something like that, most people go to work to meet their needs. So I love my job, but I don't do it just for the love of it. I do it to pay the bills as well, and that's often what we do. But at some point, that's going to stop, isn't it? Again, a little different for you guys because of the beneficiary situation, but at some point, that's going to stop, and then how do you cover all this? So, that's me, 10 minutes to go. So in Western society, what we tend to do is while we're doing that, while we're still working, we siphon it off into different pots. And you might not think you've got any pots, but when you sit and think about it, they can add up. Workplace pension. You might have a personal pension. Some might have a mix of both. You might have some savings. Some of you guys will have investments. You might have, and I know some people have done this, you might have buy-to-let properties. You've probably got your own property, home, which, whilst you're paying for it, is a liability, but eventually becomes an asset, doesn't it, when you've paid for it? And if it's a 4-bedroom asset, and when you've retired you only need 2, potentially. So really, whilst this is emotional stuff to you guys, it's just raw material to an advisor, really, where you're looking at. So rather than looking at the financial side and saying, you know, oh, what have I got and what can I do with it, I like to turn it around and put you in control, really. So the sooner you start thinking about it, and your early to mid 50s are a perfect time, really. Early to mid 40s would be even better, and I tried to break it down into 4 simple questions that we can all understand. Because there are 3 veins to all areas of financial planning. Call it MLE, maths, law, and emotion. So the maths, you guys have been working out yourself, haven't you? Or we can do on the calculator. This times this is that. Law is what you're allowed to do, so you can have 25% tax-free cash, tax relief, all that. So I can cover those parts, but what I can't cover is the emotion. So when my daughter says, oh, Dad, I feel sorry for you, I've seen your schedule, you've got 15 meetings tomorrow, all on pensions, yawn, yawn. Well, it won't be, will it? Because even if all 15 people were in the same financial position, they'll all want to do something different, won't they? Because that's the emotion. Some people want to travel the world. Other people want to watch Jeremy Kyle. Suit themselves, can't they? So that bit you should really think about before you go and see any advisor, because otherwise he's just going to tell you, he or she's going to tell you what they'd do, and that might not be what you're looking at doing. So ask yourself these questions. What, when, how long and how much? What is the key one? And it works best on a sunny Saturday afternoon with a glass of whatever it is you like to drink, or a cup of tea, with significant others. And the what is, what do we want to do? So when we're not working full time, another word for retirement really, but just swap the words. When we're not doing this full time, what do we want to do with our lives? How do we want it to look? Do we want to travel? Don't we want to travel? Are we going to do a bit of part-time work? Are we going to do some whatever? That's the what that you've got to come up with. What are your dreams? What are your goals? What's on your bucket list? All that stuff. And then you've got the when. When do you want it to start? Okay, because when do you want it to start? For some people might be 60. Just going to check time, sorry, because a few people walking past the door. Oh, no, we're okay, they're wrong. Some people might want to go at 60. What's the earliest you can access your money in a DC scheme? 55. Some people aren't going to want to carry on till they're 67. It's for you to work out, and don't matter what you put first. Put 60 at first, because this is a game you can play every Friday and switch it round. They're not getting value for money in these other sessions, are they? They're all finishing early. So that's the when. When do you start? Now, a question that a financial advisor can't really ask you is how long. What do I mean by that? How long do you want it to last? Quite an important question for you guys, because all the money doesn't need to last for all the time. Whatever you do, you kind of can't get rid of the beneficiary money that I don't know if it's called it's not called a salary, of course, is it? What's it called?
Annual grant.
The annual grant. That's going to come anyway, isn't it? So really, you might be thinking different to other people. Think, how can I get my hands on the other money as quick as I can? Or maybe not. You just want to lump it all in. But it's a question to ask yourself. What do I mean? How long do you want it to last? Well, if you're 58 now, and you know you're going to get your state pension at 67. Some of you might get some more pensions kicking in when you're 65. You're going to have your grant at 67. You're going to have your grant. You're going to probably have about between 8 and 8.5 grand state pension, and then whatever else you've got lined up. So most of that's index linked at some point or other, which is great when you're 67. Think what you can do physically at 67. Might still go skiing down red runs, black runs even. But then think of the same thing, what you're going to be doing physically at 87. And that's only 20 years. And at 87, you're going to be pretty wealthy, because you don't need as much money at 87, save your care, obviously, which is an additional issue. But you don't need as much spending money, as much spice money as my parents would have said, when you're 87 as you do when you're 67. And I have lots of old clients who ring me in their 80s and their 90s. What do I do with this surplus income, Chris? And I always say the same thing: spend it. You know, spend it. What's an old man like me going to spend it on? A guy called Fred said to me one day. I said, what's age got to do with it, Fred? He said, well, 20 years ago I knew what to do with it. Have the energy. So that just made me think, and you have the opportunity to pass that on. Think about the same thing. You know, think about what you can do when. I'm not saying here you go out and blow all your money early, but all the money doesn't need to last for all the time. And so your final question then is how much? And the how much is just working it out. Look at this lifestyle. Do you want to do loads of travelling initially as you retire and peter it out? What do you need? If you're 10 grand short for the first 5 years, 10 times 5, 50,000 quid, you're 50,000 pounds short. Might you be able to get your 50,000 pound out of downsizing? Now, there's always lots of different ways of looking at it, and that's why I love doing financial education rather than financial advice, because we don't have to fill in loads of questionnaires for you guys. These are just ideas and things for you to think about before you take proper advice, of which there's some people about today, I think, who can possibly help you with that. So remember, all that's just raw materials from an advisor's point of view. Favourite phrase about planning: if you don't know where you're going, how the heck do you know when you get there? You can always recognise someone who's got a plan, because she'll say, "Hey Rose, you're retiring in about 5 years, aren't you? You know what you're going to do?" "Oh, that's what I'm doing in 5 years, that's what I'm doing tomorrow." Or then you say, "Sheila, you're going in about 5 years, aren't you?" "No, I'm going in 3 years, 14 days and 6.5 hours, and here's what I'm doing." Because she's got a plan, hasn't she? And she knows what she's doing. So soon you start thinking about it. In my experience, people who do think about it and do start planning turn it into a reality. And then often the next question they'll say is, "Chris, remember when we did this and we were talking about going at 62? "Yeah. "Well, look, we're getting really excited as time goes by. We've seen this camper van. Oh, will it work at 60? So they start bringing it back. And it seems to me, most of the people I know, the ones who retire earlier, tend to live a bit longer as well, strangely enough. But I'd like to thank you for your attention today. Has anyone got any more questions before we
Thousands.
move on to the next one? I'll see you in the lift, Mikey, on the way back up.